Hello, George and Anna. Jordan here from Outway Finance. I'm following up our meeting. Thank you very much. Now, just to go back over the main thing, the crux of the meeting is that you guys are under some cash flow pressure at the moment. You've got these loans, these properties, and with a recent job change, you're now under a little bit of pressure, seeking a structure that A, doesn't involve selling any of the properties, you wish to keep them, but gives you a bit less outgoing per month. Now, what this scenario does is it's looked at the lenders who fit the bill in terms of low cost, but also are able to provide a better cash flow structure. And there's a difference between the two, which I'll explain in a minute. The other thing is that we have to make sure it's something that can actually be approved. Unfortunately, when you are in a period of feeling a bit more of the pinch, it's also a sign that it's going to be harder to get a restructure approved of those loans as they stand. And this is certainly the case here. So what we've done is we've looked at banks providing the best prices in certain categories. We're taking investment debt and looking at interest only for that. Now, that is a way to lower the cash flow impact of that loan because obviously you're paying interest and not paying principal. So part of that payment actually is taken out. The next one is principal and interest for your owner-occupied because that's the cost thing. That is about making sure that the most expensive debt in the mix is actually at the lowest interest rate. Why is it the most expensive debt? Well, because there's no tax deductibility on owner-occupied debt. So the rate that you get is the rate that you pay. When it comes to investment debt, the rate that you get is effectively discounted by your marginal tax rate. So if you're taxed at 35%, then your interest rate deduction, the discount that comes from tax deducting your interest on investment debt is 35%. So for that reason, this is less expensive than owner-occupied. So it makes sense to focus your energy on paying off owner-occupied debt over investment debt. And that's how you manage cost over the longer term. Now, also in this mix here, what we've got, I've tracked your sort of existing loan, property base, rates and everything, and structure. So everything is on principal and interest. So there's an improvement we can make with cash flow just there and also cost, as I've mentioned, with that owner-occupied investment interest only principal and interest split. Now, we also have here that because you've moved, these loans and rates are mismatched. Pegs Creek was where you used to live, that's the smallest debt in the mix, and East Perth is where you now live, and that's the second biggest in the mix. So it would make much more sense to get this property into an owner-occupied rate. So that's one of the structural changes that can be made. I've tracked your cash flow here currently, and it's obviously negative. That's the impact of negative gearing overall, but also because you've got $4,000 of owner-occupied loan in the mix. And then I've also looked at loan-to-value ratio to see whether or not any of that will present an issue with the restructure. Everything being under 80%, generally there won't be any issues there. So that's a really good thing. Now, the banks that we tracked aren't necessarily the shortest list of the most of the cheapest banks. We did your headline servicing in this calculator, which is a bit of an Uber calculator. It covers all banks, but the details are very, very specific. So you get sort of a ballpark indication of lending capacity here, but then you need to go in and do the specific calculations. And based on those specific calculations, this was a shortlist. These were the people who were getting as close as possible to the total debt capacity needed to get this loan approved. Ultimately, as you can see, when we did those detailed calculations, the only one we could get across the line was UBank. And we're talking marginally across the line, but even marginally is enough. Even marginally under the line, unfortunately, is not enough. And some of these banks were very, very close, but we just couldn't quite get them there. So UBank was not the first preference for cost, but it is the one out of the short list that does service. And unfortunately, it's the only one, so it's the recommended bank to go for. Where does it sit on the list? Well, in terms of the owner-occupied rate, it's equal 7. So that's the most important thing in terms of overall cost of this outcome. It's the second best bank in that regard. So that's still pretty good. It doesn't quite get there. It's equal 5th in terms of the interest-only investment rate, but it does service. So yeah, and look, to be honest, Up here in Bank of China, you did say any bank is on the table as far as this restructure. They're well clear of the market at the moment, and so exceptionally good, but that's a bit of an outlier. Most of them are sort of clustered in this 6+ range, so you're not too far out of the best rates available for interest only, sitting on 6.19. Now, when we looked at the debt servicing and cash flow outcomes, we looked at two scenarios. One involved keeping Peaks Creek on a principal and interest basis, and one involved converting it to interest only. The reason why we did that was because of how tight debt servicing was. Now, this one we could make service based on no changes to your situation. However, this one we were able to make work if we address the credit card. You've got a $15,000 credit card limit, you pay off the balance every month. So potentially there is scope to cancel or reduce that limit. And if we can get that limit down to under $5,000, then this scenario does service and therefore can be approved. The issue we have, so as far as how they compare with your cash flow, is that one is $850 per month in your pocket, so $850 less cash flow out the door. And this one is $1,150 less cash flow out the door. So this is obviously more favourable, but because it considers sort of more interest-only lending, it potentially could be higher cost. Obviously, with any debt, once you get on top of your cash flow, it is best to get rid of it because it costs money the longer you hold it. Okay, so this one here involves getting the credit card down to under $5,000. It tidies it up. We've got one bank. We've got an offset product proposed for this owner-occupied loan, and we've got simple products proposed for the investment interest-only loans because that will save you with the annual fee per annum. So again, a small but overall beneficial cash flow benefit there. So this is the recommendation. New bank with an interest-only structure across the investment loans, principal interest on East Perth, saving you $1,153 per month in cash flow. And certainly once you are on top of that position, highly recommend paying down firstly this loan as your focus point and then on to the other loans. Thanks very much, guys. Look forward to working with you.